All right, beautiful. Welcome back, ladies and gentlemen, to another ShareWise webinar. My name is Harry McCaskill, one of the senior advisors at the firm. Today, we're very lucky to have the Executive Chairman of the 360 Capital REIT, Tony Pitt. So, Tony, welcome. Thanks for your time.
Thanks, Harry, and thanks for having us on your platform.
Oh, our pleasure at ShareWise. Obviously, it's a good way for you guys to have a little bit of a Q&A with shareholders and anyone that has any questions. But for anyone who doesn't know, TOT is the ticker code, and they have a very, very sound real estate investment asset class. I won't say too much. I'll let Tony steal the show, go on with everything he wants to talk about, go through the presentation. Feel free, to jump in at any time with any questions you've got in the Q&A section or in the comments section. I'll try and get to as many as possible, and we'll have a Q&A at the end. But Tony, I'll let you take it away. And again, thanks for your time, and share your screen when you're ready.
Thanks, Harry. I'll just see if we can get technology to work here.
I'll let you know. Perfect.
It's all up and going there.
All right, stage is yours.
Thank you.
You could probably go into presentation mode, which would be present in Teams. Oh no, yeah, there you go. Got it.
Yep. Excellent. Technology is working. Thanks, Harry, and welcome everyone to this webinar and taking the time to listen to 360 Capital and our story. It has been some time since we've engaged with some of our unit holders. I think it's a great platform to do it. So today I'm going to talk about real estate equity REITs. James Story, our CEO, did this platform last week on our mortgage REIT. So today we're talking about equity REITs, and in particular 360 Capital REIT being our equity REIT. First of all, I'd like to talk about sort of the manager and our history. So we've been around for 18 years, 12 as an ASX listed company, and we're a little bit different to everyone else in that we're a manager and we're an investor of just real estate assets across debt and equity. With that, the group is quite tightly held by staff and directors, and that co-investment, we think, alongside our fellow investors, both in the group and in the platform, is a really important alignment of interests. During that 18 years, we've actually undertaken 5 IPOs. We've sold a couple off, done a lot of corporate transactions in the real estate space, and been through, obviously a couple of real estate cycles. Coupled with that, we've undertaken about $3 billion of direct acquisitions and disposals of real estate assets across a number of sectors, obviously office, retail, industrial, hotels. We were sort of early in the data center space, and through our lending activities, residential, we've done hospitals and also digital infrastructure during that journey. The manager itself has no debt, well capitalised. We've got $100 million of cash, and really focused across just real estate debt and equity, with a very disciplined approach on how we look at real estate. Just touching on the commercial real estate market in Australia, obviously it's been through some tough times over the last couple of years. We see the market sort of peaked in December 2022, and since then we've had 13 interest rate rises, which has been quite detrimental to the commercial market, particularly in office, where you've seen some other headwinds from work from home and that sort of thing. We're starting to see a bottoming now. If you look at history, it's sort of 1.5 to 2.5 years from peak to trough in the cycle. We're now 2 years into it, and we think later on this year we're going to start seeing some good opportunities coming through where we can extract some value in buying assets again. Until then, we're going to remain disciplined as we have done over the last couple of years. Just looking at the office or the segments within the commercial real estate market in Australia, there's obviously multiple classes. I'll just stick to the main 3 being office, industrial and retail today. So just starting to talk about office. So as we all know, work from home has been detrimental to the office sector. That's now changing. You're seeing it in the vacancy rates coming down, particularly in the premium and A grade end of the market, and people coming back to work. You've also seen it from an investment perspective. There's more interest in office again as an asset class, because it has been hit very hard over the last 2 years. What you've seen is obviously cap rates or yields on properties blow out as interest rates go up. We've now in that cutting cycle again. How deep that cutting cycle will go, we don't know. But we think that cap rates and values have stabilised, and we're getting close to the bottom of the market there. When you look at the occupier for office workspace, it has changed with work from home. There's got to be more flexibility in how office landlords approach it. Companies are wanting more amenity in their office, end of trip, good location, and that sort of thing. The other interesting thing or other trend is obviously a flight to quality. So you've seen premium and A-grade office assets hold up relatively well, well leased, whereas you've at the other end of the town, the market secondary assets, you've got a real bifurcation now, and a lot of these secondary office assets, they actually need repurposing, and that's a very tough mark there. And a lot of the values of these B grade, C grade assets have a long way to fall back down to what is really site value. The opportunities that we see in the office market is really driven by special situations at the current juncture, maybe larger A REITs offloading assets to correct their balance sheets, potential fund throughs, and we can do that as a group across debt and equity with repositioning and that sort of thing. There's a lot of single asset office funds that are coming to maturity. Investors don't want to roll over, so that's the sort of area that we're looking at, trying to find opportunities to grow our REIT. In the industrial space, obviously had strong thematic here, and with the supply chains as they were quite locked up. Companies needed to have more inventory, that needed more warehouse space, and as a result, you've seen a big growth in this area. You've also seen a lot of capital flow to this market, particularly in larger properties dominated by large overseas groups buying assets. That's created a little bit of speculative supply in the market. Vacancy rates have started to tick up a little bit as companies have got more efficient with their supply chain again, and as a result, incentives have come into the market. But you've had very good rental growth coming through on the whole. Cap rates have softened somewhat. They got very tight in the peak of the market there, but it is the preferred asset class as a lot of the capital is looking at. And like all three sectors, construction costs remain high, so there's a floor in the economic rent where it takes to replace a lot of these assets, and a lot of assets are transacting below their replacement costs. Opportunity here, as we see in the industrial market, it's really that infill opportunity, using our property skills to release excess land, expand facilities, and also fund throughs with an end takeout being our REIT there. Typically, we like as an organisation to work off market, and that's how we typically try and get our assets there. Just on the retail side of it, we have done retail in the past. Our preferred area is really in that non-discretionary sector. Discretionary sector may still be under a little bit of pressure, but it's performed actually quite well as asset class, because the sector was hit more so with internet shopping and the like earlier on in the cycle. So cap rates didn't get as firm as opposed to some of the other asset classes, and as a result, the softening hasn't been as dramatic. Also, people or investors are now looking at how they can activate excess land, whether it's residential or the like, on what are quite large land banks within these retail centres. Once again, there's a lot of single asset funds that are coming to maturity. A lot of those are rolling over because they have performed relatively well. Just turning to our REIT, 360 Capital REIT, which is listed on the stock exchange on the ticker code TOT. So this fund here has 3 assets in it. It is unique in that it provides actually fully franked distributions out of this REIT, which is unique. Most of the tax is paid in the hands of the investors for other REITs, whereas this REIT, you get franking credits. Being a small REIT, it trades at a fair discount to its NTA at 34% at December, but it's not dissimilar to other REITs like it. But it is an attractive yield proposition, pays a quarterly distribution at a current price of 7.6% yield in current price. And when you gross that up to the franking credits, it's about 10.8% on an equivalent basis. 12 months ago, we actually recapped this REIT and brought the gearing right down and stabilised the capital structure, which was a very hard decision to do, but we undertook that as an entitlement offer, and we sold out of the non-core assets. So we have a core $200 million portfolio, modern assets, average age of 4.2 years, with a weighted average lease expiry of 6.9 years. Why that lease expiry is important, if you look on the right there, the portfolio lease expiry, very little in expiry coming through. What that means is obviously we don't have to fund capital expenditure to retain tenants with incentives and that. So we've got a very clean cash flow going forward, as opposed to a lot of the other, particularly office REITs, that have a lot of expiry, a lot of incentives, and a lot of below-the-line expenditure that typically they have to fund with borrowings. Occupancy of the portfolio, we only have 1 vacancy in there, so 93% occupied, and being only 4 years old, they're all 5-star NABERS rated. When you look at the tenant profile, 93% of the tenants are either government or listed companies on an exchange, and with strong private companies coming through there. So security of income and distributions is what we're looking at here over a long period of time. The portfolio itself, 33% pure office, been in Canberra. A building in Melbourne is actually office and a registered hospital. And then up in Brisbane, we've got Michael Hill Jewellers International, which is a industrial manufacturing facility we'll go through. So just touching on the assets very quickly. So first one in the ACT in Canberra, about 1 kilometre away from Parliament House. So well located, modern buildings, had a lot of money spent on this prior to us buying it. And as you can see there from the lease expiry profile with a 9.4-year WALE, very secure cash flow coming from this. We've recently undertaken some major leasing in this on level 1, which has extended the lease term and also improved the earnings of the fund. 34 Southgate Avenue in Cannon Hill in Brisbane. This is a purpose-built facility for Michael Hill International. It's the largest jewellery manufacturing facility in the Southern Hemisphere, built with a new 10-year lease on it specifically for them. So usually with that sort of arrangement, tenant stays for a long time. Michael Hill were in their last premises for 28 years. We expect them to be in this just around the corner from their previous one for a similar length of time. Very hard for a tenant like this to move. Looking at a new build, it's actually where their economic rent needs to be is below a lot higher than what's currently passing. So to replace this building, obviously it costs a lot more than what it's currently in our books at. So all those factors, we think they'll stay. 510 Church Street in Cremorne in Melbourne. As we all know, Melbourne has been quite a tough, it's quite a tough state at the moment. In the commercial market, it has been extremely tough, particularly in the CBD. When you look at Cremorne as an area, not too far from the CBD, good amenity, This building is only 4 years old also, and is half owned with ourselves and with a private Melbourne family who developed the property. Why we like this locality, obviously with an amenity, if you look at the after end of trip facilities, car parking, rooftop activation area for the tenants. There's a lot of amenity for the tenants in here, and it is an attractive building for that. In saying that, it's still a very tough market. We have 1 floor vacant in here. We issued some terms this morning, so hopefully touch wood on half of that. But it has been tough to lease that up. But we have done the fit out in there, so we don't have the capital expenditure to spend in there, and hopefully we'll have that leased shortly to continue to prove the earnings of the fund. So why invest into TOT? One, it's a very attractive yield, 7.6% paid quarterly. As I said before, when you gross that up for franking, it's about 10.8% fully franked. Equivalent distribution yield. The portfolio itself, being modern, 5-star neighbours, minimal capex from tenant incentives to be spent. In fact, there's no capex really to be spent from a tenant perspective. It has been spent with the fit out on level 2 there at Church Street, and the portfolio is entirely revalued as at 30 June 2024. The tenant profile, what we look for is really certainty of cash flow and strength of tenant, being government and ASX over 83% of it on that long 6.9-year WALE, with inbuilt annual rent reviews averaging 3.1%. You've got that built-in growth in the cash flow coming through. And with the recap that we had to undertake recently or last year, we've got a very stable capital structure. We don't need to raise any further money as we go forward. So, we're very in that stable, predictable cash flow sort of regime now, which is obviously what we like to get those distributions coming through. It is an income-focused fund, but given it's trading at a steep discount, there is the potential for capital gain as the market improves, which we think is doing definitely this year. It's definitely seen a lot more interest in the REIT sector for those reasons, and there's more confidence comes back to the sector in valuations and that sort of thing as the market starts to open up again. Last point, alignment of the manager. In terms of corporate governance, we think this is the best corporate governance you can have. It's currently about 44% owned by 360 Capital Group. As I mentioned before, the group itself is owned over 50% by the people running the REIT. So our alignment is very strong, and that's a philosophy we hold very dearly over our 18-year history. Given that the REIT has no legacy issues compared to a lot of our other comparable REITs, we're in a great position to be able to grow, but we are going to be very disciplined in that, make sure there's accretive acquisitions coming through and creating value for top security holders. Lastly, just looking at peer comparison, we are the smallest REIT on the ASX, but I'd say that we're probably the cleanest REIT, so that gives us an opportunity to grow. A lot of capital is looking for alternatives, and as we go forward, we'll be looking at, in due course, bringing some further investors on board as we grow the REIT out. In terms of gearing, very much under control. We have a covenant of 55%, so 20% headroom there, give or take, and is below the peer set. We don't think the market really understands the fully franked nature of this trust, hence why when you look at it on a comparable basis to our peers, that fully franked distribution in the hands of unit holders is an asset of the REIT that is not priced appropriately by the market, we feel. And then discount to NTA, look, we're in line with a lot of the others, and as I said earlier, we do expect that gap to close in a couple of ways as the REIT grows as the confidence starts coming back into the commercial real estate market, you'll expect to see that gap close. With that, I'll hand back to Harry for some questions.
Tony, thank you very much. A lot to go through, obviously a lot to digest. Now, I like to sort of ask, a lot of investors, they invest based on the management team, the people who are behind the business, right? Can you give us a little bit of insight, around the team that is, pushing everything they can to get, 360 Capital REIT to where it needs to get to?
Yeah, look, when you say where it needs to get to, we've done a lot of the hard work already in terms of recapping it and leasing and that sort of thing. So the team itself, very hands-on. We do take a very hands-on approach with our assets. We're known in the market to be very active managers of our assets.
Yeah.
And, we do see, I suppose we look at assets or opportunities a little bit differently than, going on market and buying an asset that's been put through the market and, every man and their dog's looked at it and you're really competing. Where we try and come from is really look at buying assets in an off-market situation and typically not the norm. You've seen that with a lot of M&A activity over our period of time and growing some of these REITs that we've subsequently sold to over $1 billion in market cap. This is the journey we want to go on with TOT, but it's going to take some time and the stars need to align with interest rates coming down and the market correcting.
Yeah, beautiful. Because obviously a lot of investors, especially long-term shareholders, they've seen the share price, come off, relatively, slowly, but over a long period of time, it's something that, they want to see turn around. And there's been a lot of questions coming through regarding the share price and trying to get more attraction towards TOT without diluting the price moving forward.
Yep.
Have you considered selling properties to close that gap to I guess, fund operations moving forward? Or, what is the key approach?
So if you look at the market at the moment, there's very little transaction activity. We could sell a property and, it would not be a good result for TOT at this present stage. You've got to look at, we bought these assets. Unfortunately, we got caught with a situation we bought at the peak of the market.
Yep.
But on the flip side of that, the REIT made a lot of money from the Irongate transaction, which is delivering those fully franked or the franking credits, if you like. So yes, look, we've had approaches on assets. We've approached people on assets to sell it. Easy to say, look, why don't you go and you've done the leasing at Canberra now. We've added a lot of value in that lease. Why don't we try and sell that asset now?
Yeah.
And we buy back and close that gap or whatever it may be. We'd love to do that, but it's not the marketplace to do that at present.
No, let's understand. I mean, everything, as you mentioned before, it's all about timing, right?
It is.
And you'd rather a little bit short-term pain rather than long-term pain. So obviously at this point, that wouldn't be a long-term smart decision. No.
And investors should look at this as a medium-term investment. And, the commercial markets do correct. I mean, we made a lot of money in the previous cycle for our investors through buying, pretty close to the bottom, and then we sold out, our entire platform for over $300 million in 2017. So we're not scared to sell assets. We're not an accumulator of fund. We're more investors than fund managers.
Yep.
But we are we're very much aligned in driving value. If we can get a great price for an asset, it gets sold. If we don't need to. So
beautiful. There's also a lot of questions coming regarding the franking credit situation. Can you just touch base on that a little bit for the people listening, and also just elaborate on how long you potentially expect the franking credits to last at the current rate of distribution?
Yeah, so the unique nature of TOT is these franking credits came from, we did a a very large deal where we had a stake in a group called Irongate back in 2022, which created a very large profit, which we had to pay tax on, created a franking credit. That franking credit is about 2.5 years. So based on the current number of units, we can maintain a fully franked distribution for about 2.5 years at 3 cents. Now, we do expect that 3 cents to grow over time.
Yeah.
But if you look at it really simplistically, then given the nature of the fund being 4-year-old assets, we've actually got a lot of depreciation allowances as well. So after we're finished with the franking credits, we've actually got 4 or 5 years of being able to provide 100% fully franked distributions if the capital structure stays the same. So from an after-tax perspective, this is a very attractive vehicle, whether it's a super fund or privately or what have you. And the market doesn't understand that. We've got to do a better job at doing that, and that's what part of today is about. Yeah,
beautiful. And just I guess sticking in I guess the same area in terms of the financial position in the business. Are you in any position to do any sort of share buybacks of TOT, or is that something that would be a little bit further down the road, just considering where things are at?
Yeah, look, at the moment, its gearing is at the lower end of the 30 to 40% band, but we're not in a position to do buybacks at the moment.
Yeah.
What you do have is the group has been buying securities. I've personally been buying securities because I think there's value there. Love to do a buyback, but it just doesn't have the capital to do that at the moment.
Okay.
For sell an asset, we would look at doing a buyback. We're sort of not looking at making this fund smaller because we think the gap will actually close if you make the fund more relevant.
Yeah.
That's what we're looking at more so.
Okay, beautiful.
It's a tough task to do. Yep.
Yeah, because I guess it's also very dependent on the real estate market in general. It's the commercial real estate market. Do you see the bottoming of this market forming, and what is your outlook on the commercial investment market?
Well, as I said before, we are seeing a bottoming. Whether it's today, there's conjecture whether it's today, 6 months, or whatever it is. We're long-term investors. We're not going to pick it to the day, and if you are, you're a genius. But we do see it sort of bottoming, and you see that with interest rates starting to come down, people coming back to work, and more interest coming into the commercial sector. That's going to create more transactional activity, more capital coming in, and that transactional activity will allow the valuers to then, have more confidence in their valuations, and hence share prices will grow and close those NTA gaps.
Yeah, definitely.
We do think it's sort of, getting pretty close to the bottom.
Yeah,
we've been very disciplined with it, with our
approach. I guess obviously the interest rates, potential cuts moving forward as well. The RBA, they just cut interest rates this month, so that's a positive outlook moving forward as well. I guess you look at the broader market as well, the retail market. That could sort of start to trend upwards from here as well. With regards to, I guess, the whole commercial REIT investment trust, space and I guess sphere. What differentiates you guys in this space compared to other REITs at the moment?
Yeah. So our REIT is very simple, right? It collects rent, it pays the bank some interest, it has some running costs, and it distributes its cash flow. A lot of the other REITs, have other activities attached to them, like fund managers, development activities, and that sort of thing. This is a very sort of simple rent collecting vehicle versus operating activities at the moment, and that's what's differentiated to TOT. When you look at the office funds in particular, and TOT sort of, I suppose, caught up in that, going back to my point about being a really modern portfolio, we don't have that below the line incentives, payments to tenants to keep them in the buildings, because we just don't have any expiries for a number of years. And even the vacancy that we have, we've already done the fit out. So we've actually spent all that capital. So we don't have that below the line. also been modern. We don't have to refurbish these buildings. Once again, below the line increases debt. So it's a very sustainable capital structure that we've created here to spring from in due course.
I guess from your perspective, it's more streamlined, and I guess it's more simplified, less admin.
It's very simple, right? It's as simple as it gets. And we don't, as a business, we don't do development ourselves. I've taken it as a principle. We're an investor first and a fund manager. Other REITs do development and that sort of thing in their vehicle. This is not undertaking those activities. Beautiful.
Thanks for answering that one, because there's a few questions coming through regarding that. We've got another one coming through. The question is the debt still unhedged? If so, what are you expecting impact on distributions to be from falling rates?
Yeah. So when we did the capital raising last year, our focus was really getting this 100% leased, and on the current interest rate, which at that stage was 4.35, it generates 3 cents earnings. We have purposely kept this fund unhedged over the recent period because we see interest rates falling and coming down. Any saving in that goes straight to the bottom line, which we will then distribute. So, if you talk about the earnings growth coming forward once we've done that final leasing, you pick it at 3%. 3 cents. Every saving, every interest rate cut, that's going to the bottom line, coupled with the fixed increases in the rents or the leases that we've got, we're getting 3.1% growth in our cash flow. So from here, you should see distributions increasing over time.
Perfect. Well, hopefully, Nick, that answered your question regarding that. Now, another one that came in prior to the webinar: how specifically do you and obviously everyone else behind the scenes at TOT intend to achieve its stated goal of marketing to new investors and gaining increased broker coverage? And on that, have any new brokers commenced any coverage on the stock in the last couple of years since it's been mentioned in that first initial goal?
Yeah. So doing things like this, Harry, is really important. We have been quiet and really getting on with our business of fixing this vehicle, getting that leasing underway, and particularly in Canberra. So investors are going to see a lot more of this coming through, and that's important about getting more awareness out. In terms of broker coverage, we have a session, I think it's later this week, early next week, with Moelis kicking off there with a whole lot of fund managers, once again getting that awareness out and going through the results. And then with broker coverage, it's a bit of a catch-22 with brokers, because they want you to be doing things, raising capital, to then do the research and make it worth their while. They are commercial organisations, for example. But we do have a number of brokers who are starting to look at TOT from a research perspective. It's probably when TOT gets more active in buying some assets, doing a bit of a capital raising, you're going to start seeing that research coming in. The other thing you're seeing in the REIT market is it is a sector that is consolidating. So there's a lot of hotel property investments suspended shortly. So you're losing the sort of spread of the investable market. So as that happens, people start looking at TOT as an opportunity.
Yeah, and things could potentially be seen as a bit of a cyclical low. The commercial property at a low, and a little bit more traction coming in there. Now, with regards to legacy issues, what do you actually define that? And can you just elaborate a little bit more on that for those listening?
Yeah. So when we talk about legacy issues, as a group, we had a lot of different avenues or businesses that we were doing. We've actually streamlined that back to being purely real estate across debt and equity. What that means is we have a lot more focus now on fewer things as a team. In terms of legacy issues within TOT, the main one was really we had a non-core asset from something we inherited previously. that had taken a number of years to sell out. We did that over the last 6 months. Been an interest in unlisted fund, and the recapitalisation, not so much a legacy issues, but something we had to do to stabilise it. All that hard work's done.
Yeah.
I wouldn't call this a legacy issues, but our focus is really getting that leasing done at 510, being that one floor, which hopefully we can get some good news coming through shortly on that.
Yeah, again, it's a patience game. Patience, it's a virtue, that's for sure.
You got to be active, right? And we are active.
Yeah, beautiful. And one last comment and question, I guess, coming from the viewers, and then I'll finish it off. David, he's asking, how much money did TOT make from buying and selling its stake in HPI?
TOT did not. TOT was not involved in HPI. That was actually 360 Capital Group. We have a history of doing these types of things. We've put about 900 million of equity to that strategy and averaged about 20, I think it's about 24%. With HPI, we actually made 1% return, but from the group perspective, it's not TOT now. It was important to get that cash back to the group, as we could see the market sort of doing what it was doing. So it didn't make a huge profit, but having that cash was important to us.
Yeah, sort of, clearing up the balance sheet and de-risking. You could look at it that way.
Well, it's de-risking, and we look at it as an opportunity cost to have something sitting there versus having the cash. For our other businesses, like our lending business, we're using that cash to do non-bank lending in partnership with our mortgage REIT, and that's important from not only TOT's perspective in terms of securing assets and that sort of thing. Just gives a lot more flexibility and a lot more credibility when you are bidding for assets, when a vendor can see that the cash is actually available wherever that asset may sit.
Beautiful. And just one more question comes to mind, just back to the financial side, because again, people want to invest in a fundamentally sound business, and you'll start to see traction once those forecast guidance of earnings and revenue are consistent. What is the forecast? What is the guidance regarding earnings and revenue? Is it looking to increase over the next 2, 3, 4 years, or is it looking a little bit stagnant? What's your take on that?
No. Look, as I said before, these leases have inbuilt annual rent reviews, typically I think the average 3.1%. So the cash flow coming through from that is increasing. So if you look at where we are today, cash flow will increase with 1, getting that lease done down in Melbourne, 2, the natural rent reviews coming through, and 3, as interest rates fall, TOT gets 100% benefit to that, to the bottom line, because it is unhedged. At some point, we will hedge the debt. Now is not the time to do that.
Beautiful. Well, like I said at the start, lots to unpack. And Tony, again, I thank you for your time. But one last question before we wrap things up, and hopefully I got to a lot of questions that were coming through. But something I always like to ask is, if there's one thing that for a new shareholder or current shareholders to know, why should they continue or become a shareholder of TOT, in the near future, or continue to be a shareholder?
Yeah. So why continue to be TOT? Look, it's been a bit of a rough ride a few years ago. Why they should continue is a lot of the hard work has been done, and it is upside from here. You're getting a very tax advantage income return coming through. The capital growth should come through from 2 things: the natural rent reviews coming through, higher cash flows, cap rates firming is going to create potential capital gain. And then the other one is just the discount to NTA. You're buying assets that are well below replacement cost, and then discounting them another 30-odd%. That's why I invested in it. So, yeah.
Beautiful, Tony. Well, again, everyone, thanks for your time, ladies and gentlemen, for watching. It has been another ShareWise webinar. Sorry, it is recorded. So if you've sort of missed out on the start or at the end, feel free to jump on our YouTube channel, our website. You'll be able to rewatch that one. Tony, I'm sure he'll make sure that's on their social medias as well. But Tony, any final regards from your end?
No, look, Harry, thank you, and thank you to Sharewise. Like our mortgage REIT, we'll be putting it up so that those that didn't see it can see it. And we're always available for questions and open as a management team to try and answer queries where we can.
Beautiful, Tony. Well said. And again, if anyone listening would like to get in conversation with an advisor here at Sharewise, that's always a possibility. Jump on our website and you can speak to an advisor. But again, enjoy the afternoon. Tony, take it easy.
Thanks, Harry, and thanks for everyone for tuning in.
Cheers.
Cheers. Thank you.